All right. Well, I think we are ready to roll. Rashad, you ready?
Yes, sir.
All right. Excellent. All right. So moving on now, we have started off the multifamily with the broker panel. Now we want to dive into the operator panel here. We have an incredible lineup here. I want to just go down and give everyone a quick moment to introduce themselves. So we want to start off. I see. I'm just going by order. Video showing up here. We got Chris on the line. Chris Jackson on the line here. You want to introduce yourself?
Sure. Chris Jackson, Sharp Line Equity. I've been doing real estate for about 10 years, but syndicating the last about 6 or 7 years. A little over 500 unit transactions. We currently have a little over 300 units, but we have about seven full cycle multifamily projects under our belt. So we've purchased, raised the money, refinance, exit 7 times. So we have experience with all done bridge loans, done heavy value adds, done stabilized debt. So I have exposure to the gamut. It's good to be here.
Hey, you also have your analyzer coming out. Why did you pitch that?
I do.
Yeah.
Great. I was waiting for it.
Synthesis, man. It looks good.
Yeah. themultifamilyanalyzer.com. Check it out.
There you go. Love it. Omar.
Hey, guys. I run Boardwalk Wealth. We've got assets in Texas, Florida, and Georgia. And I'm really excited to be here. Looking forward to talking to everyone.
Excellent. We got James.
Can you guys hear me?
Mm-hmm.
All right. James Kandasamy, owner. I mean, we own like almost 1,700 units as a sole GP. I mean, without passive investors, but we are sole GP in all that transaction. I've gone 8 deals, 9 deals. 1 has gone full cycle. 3 has gone full refi with 100% return within like 12 to 15 months. And we still have almost 1,600 units right now, focusing in Austin and San Antonio market. We are value add guys, have done deep value add, and have done slightly less deep value add. That's it. It's always value add.
Always looking for the value. Excellent.
Absolutely.
We have, is Bill? Bill, you on the line?
Yep, I'm here.
How's it going, Bill?
Good. Bill Ham with Broadwell Property Group. I'm the Chief Operating Officer of Broadwell. I've been in the business about 15 years now, and been through all of the market cycles. So still here, still kicking.
Every one of them. Very good. And then back again from this morning, who kicked it off with some energy this morning, and he's back on after the marathon day continues. We have Rod.
Hey guys, Rod Cleef here. We've got assets in Texas, Ohio, Kentucky, Louisiana, and Florida, and I host what I'm blessed to say I believe to be the largest commercial real estate podcast on iTunes. We just broke 8 million downloads, called Lifetime Cash Flow Through Real Estate Investing, and I do live events and courses and coaching. And we had a sold out 900-person live stream event a couple weeks ago, 3 weeks ago, because I had to pivot from having a live event in Orlando, which of course we all know that's not happening, but no, I'm glad to be here. I appreciate you guys inviting me. This will be a lot of fun. I recognize a lot of friends. There's people here that are in my boardroom mastermind, so it's going to be a lot of fun.
Well, this is a great crew. I know we're going to have an exciting discussion here. So the first question is, should we be buying deals right now?
Well, why not? Yeah, why not?
Sure.
Absolutely.
I am. So yes.
Yeah, you can buy deals, but you have to buy at the right price, and prices
Yeah.
will be tricky right now. So you have to really go into a deep discount.
But all the same things as before apply. I mean, if you get the right price, why not?
If it's your business plan, go for it.
If you're conservative, your stress testing has been enhanced. We've got 2 assets we're closing on the next probably 45 days. One in Cincinnati and one in northeast of Atlanta, and we're very, very conservative, raising significant operating reserves. We can be 35% vacant on the Cincy deal and 25% vacant on the Atlanta deal and still break even. And the thing that we're doing is really taking a hard look right now with COVID at where these people work, and do they have jobs or have they been laid off? Because who knows how long the stimulus is going to last. At some point, that spigot's going to get lessened and turned off. And, I just saw an article that said that 30% of the renters out there are concerned with June rent. Now, who knows, who they interviewed for that, or how accurate that is. But to think that there's not going to be some fallout probably is a little naive with 40 million people out of work. So we're buying right now, but the numbers have to make sense. Yeah.
Yep. And we had David Kahn earlier from CoStar, and he was saying the C class has actually been performing the best throughout this, which I thought was a little bit of a surprise, but it was largely that falls back on the amount of unemployment that's being distributed right now. So So when you think about that, is that a opposing threat? Does everyone think that do people think the B class is a safer spot to be right now, or are you still bullish on more of the workforce sentiment? What does the group think?
I'm looking at the B space because of the newer vintage, just the asset class itself. Just looking for C class tends to have older vintages that are going to have more of a CapEx problem coming, and a lot of owners aren't going to be putting money into their properties right now that they need to. So deferred maintenance is going to get worse. So we're seeing opportunities in the newer assets that don't require as much deferred as capital expenditures.
I mean, look, we've always been leaning more towards B anyways. It's just less brain damage. Again, it's just like, if you have residents that make more money, obviously it's not a guarantee, but there's a higher probability that there'll be less bad debt and all of that sort of stuff. Bs typically tend to also be located just in a better spots. I mean, not always. And again, the thing is, which, Chris pointed out, higher vintages, better vintages just ensure that you get better rates on insurance. You have less CapEx issues, typically, less deferred maintenance, most of the time, not always. So you just have, where on paper a C might look better because, you got so much rent upside. A lot of people don't actually realize they're operationally intensive and you lose so much. You have such a loss of brain damage going through all of these that you might end up making maybe 1% more, but in the process, you pissed off pretty much everybody else,
Mm-hmm. Anything else there? About James?
Yeah, I think we have been moving towards B. I mean, we have been purchasing B for the past. For our last 3 to 4 acquisition, we have been all B class, right? So B class means it's above 90 for us. I mean, we are just looking at newer piping, newer wiring, making sure it's all up to newer code, right? That's the definition of B. I mean, of course, it may not fit with what people are defining as B in terms of year build, but above 1980, you're much better shape in terms of less capex and much better tenant demographic, and I think that's more important compared to buying at a C or C minus, where you can. I don't know whether you can get at a better price or not. It's the same price end of the day. Your cap rate probably is the same depending on the market, but most market between A, B, C, the cap rate is so narrow, it may not make sense to, do a C for experienced operator. Having said that, for new people, it's okay to do a C, right? It's okay to do a chiller system apartment, right? It doesn't matter because, they have to get started, right? So, you have to buy a deal which makes sense, and, you can struggle a bit with CapEx, but that's all part of the learning.
So we've talked a bit throughout the day on whether you should be self-managing or whether you should use third-party management and how to vet the right third-party management. Bill, I want to start off because I think you always have good advice when it comes to this, but who should be managing in-house and who should be going third-party?
Well, to my students, my advice is always manage, don't manage, and then manage again. I think you need to manage in the beginning, or I think it is good to manage in the beginning to gain experience so that you have a broad understanding of the business, but at the same time, it comes at a high opportunity cost. It's a completely separate business. You're getting into staffing, payroll, a lot of other things that have absolutely nothing to do with real estate. So really the answer is economy of scale. And so that's why I say manage early on a few units, and then I would go with third-party management until you have a larger portfolio, 1,000 or so units, where you can then kind of hire some bench talent. You've got some economy of scale. So I would recommend maybe not managing for that middle portion of your portfolio, and then when it makes sense to financially bring that back in-house, bring it back in-house. I managed through my whole career. It was great. It kept a lot of cash flow coming through the down cycle, but at the same time, it came at a buying cost. You just can't take on purchase and take over that many deals in a row. It's a lot of work. A lot of people don't realize how much that is taking over an asset. So that's why I say it's good to learn, but you really probably don't want to do it until you have a larger portfolio.
And that too concentrated. If you have one asset in Atlanta, one in, I don't know, Miami, one in Ohio,
Yeah.
you could have 1,000, but you're not going to get that level of concentration in one area.
Good point.
Right.
Yeah. So we are vertically integrated, and we have done our self management since day one itself, right? So since we bought our first 45 units, we have started managing. So we are happy with that. It is a lot of work. It's a lot of thankless job. Of course, it's going to slow down your acquisition because we are usually buy and then we stabilize and then we buy another one. We don't like buy, right, and give it to third party.
Are you all in one market though, or are you in several?
Yeah.
We are in one market, so that's a good thing, right? Because we can share resources, we can do maintenance, we run much more efficiently, and we get a lot of benefit out of it. But it's a lot of work, and we are just doing it for the control, not much for the money. It takes up a lot of your time, takes up a lot of your bandwidth from acquiring new deals, but we're doing it because we are just control freaks.
No, but it is the way to go, though. Look, if you have a lot of deals, you eventually realize. Look, I mean, I think I found a good property manager, but yeah, I had to go through a lot of really property. I shouldn't say bad property managers, but property managers where eventually you're like, dude, like, come on, man, like, help me out, right? So I don't think being a control freak in this case is wrong. I think James did the right thing, but you have to realize that it comes at a huge cost. And not just, mental, like financial cost also. There's a big upfront financial cost in taking this burden on.
Yeah. It's a people management job, right? I mean,
it's thankless.
It's the heaviest part of the whole multifamily business, but it's also the part that makes your business most profitable, right? I mean, keep in mind, property management company, they're working on a very thin margin, right? So there's going to be other channels of where them making money as well. It's nothing wrong, but it's just how the business works, right? So when you are doing it yourself, we are going to shrink a lot of expenses to our need, right? And we're going to really, really optimize because it's all our own money, right? It's all our investors' money, and we want to really optimize our investment. But it's a lot of work, and since we're doing a lot of value add, we really value that because we can control and you can turn around properties very quickly.
Right. Yeah, it's a push-pull thing, right? If you're going with third party, you can be probably a little bit more nimble and flexible to new markets because you don't have to establish the scale. But if you can bring it in-house, you have the control, and as you scale, you're going to be able to save a lot of costs and have less hiccups, right? So there's definitely pros and cons to both sides of it.
Yeah. And let me just finish one thought that I have right now. So when the market is going up, you want to be on acquisition mode because you're building equity, right? And usually the market forces itself, the tenant demand and drive is going to drive your rent automatically. You really don't have to work hard. You don't really see who's the best property manager during the market going up, right? Or who's the best property management company during the market going up, right? But now market is coming down. This is where you're focusing not on acquisition. You're focusing a lot on tenant retention, tenant happiness, right? How do you collect, right? How do you keep occupancy high, right? So you're focusing on different things, and this is where the property management aspect of it becomes so critical because you are going on a defensive mode right now in your investment cycle.
Mm-hmm. Look, and just the other thing I'd like to point out also is, okay, now I've had a few bitter experiences. You can have the same company, but a lot of times it actually really boils down to who your regional and who your property manager is. Because the same company can have two entirely different people being regionals, and one person can be extremely happy and the other person is just pissed off all the time.
Yep. And we have that right now. And you've got to interview the regionals, see what they're like, how big their workload is, how big their territory is. Yeah, good call, Omar, for sure.
Yeah,
it's all about the people. Doesn't matter. The company's irrelevant.
You're 100% right.
Agree. It's the communication between the regional manager and the property manager. That's the point of success for that deal.
Mm-hmm. So we're kind of bringing in the end of this, market cycle, if you will, having gone through a lot in the last decade. So I want to just hear from everyone, what kind of changes did you put in place to adopt to the compression of cap rates and the various stages of the cycle over the last 10 years?
Can you repeat the question? It's a bit
Yeah.
tricky.
So how is your
Okay, use easy words, Dylan. Come on. Nothing more than like
we are
5
normal
letters.
people.
You might need to share
Yeah.
your screen. Can you share your screen?
Yeah.
right? So how has your strategy changed over the last decade? Right, where you, in some cases, I think there was a bigger spread. You know, C class might have been more attractive 5 years ago versus where it was 2 years ago, right? How has your strategy changed? Have you shifted what you're looking for in properties towards the end of the cycle? Did anyone stop buying towards the end of the cycle? Just give us a sense on how your strategy evolved.
For me, it was we were only looking at C class. We were C class big value add buyers, and just in the last year, our investors are okay with slightly less returns. Let's call them boring great returns. Like that's what we're looking for, and we're looking for the more B plus assets. Now, we never looked for those before. I would never look at a 2000 built. I just wouldn't in the past, and now I'm looking at them all the time.
Mm-hmm. Is that because of your personal experiences, or is that because of the shift in the market?
It's a shift in the market also, where I'm seeing that the CapEx tsunami that Bill Ham and I always talk about is coming big time, and I want newer assets.
Mm-hmm.
Yeah, I think it's easier to discuss what we're going to change going forward than what we have changed. I think it's going to be more change going in the next year than there has been in the last year. I agree with Chris. I think it's going to be a big flight to quality. We're going to kind of move out of the affordable housing space altogether, I believe, for physical asset valuation, cap expense, hidden cap expense issues. And then me personally, I don't like where the politics are going. In affordable housing, you're really going to start to control the rent growth. At the same time, it seems that they're really being strict on condition of asset. So as an owner operator, I see less potential for growth and more potential for risk, social risk, and having the city kind of come down on you as far as physicality of the asset in an aging building. So I see we're going to kind of move out of the C space for a while, I think.
So look, in my particular case, mine was totally based on my family's experience. We've held real estate for the past 3-4 generations. And I mean, we've done all sorts of dumb mistakes that you could possibly do with your money. And look, we've realized, at least rather I've seen growing up, realized that all the quality assets we had, they saved our backside during the good and bad times, right? During the bad times when, everything's falling off the cliff. So I was never inclined, for instance, just due to those experiences to begin with, to go more in that affordable sort of range. Again, could be my personal bias more than anything else. And the other thing, straight up, I just think it's a math problem. So far, nobody's been able to explain to me, how do you raise rents $150, $200, $250 and have some guy who makes $38,000 pay you without running into bad debt? I mean, eventually it becomes a math problem, right? Forget about the asset CapEx, which is, by the way, very important. You keep raising rents $100, $200, $300, and look, your resident base can't afford it. So yeah, it's great. You can do it in 1 or 2 years if you can get out, but the problem is we don't know when the music stops. So that was my personal bias. So that's why we've always kind of lent more towards higher income demographics. Doesn't mean we haven't done stupid things. It just means we've tended to be biased more towards those types of assets.
Yeah. For me, we started in multifamily in 2015. We were doing heavy, deep value add, short-term loans, commercial bank loan, and we were turning around property within 1 year, refi into long-term loan. But coming to 2018 onwards, I've moved all my loans to a long-term loan just because, we already know. We were like really seeing that the market is going through the peak, and we didn't want to go through this bridge loan again, even though so many people were doing bridge loans, right? Because it's easy to do deals with bridge loans, right? So, now the market has shifted, we might be doing bridge loans again, right? So this is the time to really take risk if bridge loans available, right? But as long as we buy it right, we probably will change our strategy to buy more deep value adds again.
Rod?
Well, we actually, I haven't been in the market for the last 10 years. We did, $1,000 doors last year with our students, and in those markets, and we're buying in other markets. We've got those 2 units under contract, two assets under contract right now. All I can tell you is, those of you that know my story, I lost $50 million in 2008. So I'm, hit me once, shame on you, hit me twice, shame on me. I'm more conservative than probably most of the people on this call. And as a result of that, again, our stress testing is extremely robust, and it was before. So we didn't have to shift that much when COVID happened, because we were already extremely conservative. I mean, for example, our asset in Dallas is at a 65% loan to value with, above 10% cash on cash and 20% IRR projected. And we've exceeded that. So, that, to give you an idea, we're very, very conservative anyway. So again, I can't really lend a lot to this particular question.
Now, what are you guys doing? So I think everyone's on the same page with, if you're conservative enough, you can still go out there and buy deals in today's market. It's just a matter of being able to make sure, you feel what you're doing is conservative. What are you guys doing to be conservative right now? And what does that really mean to you? How are you shifting your underwriting to adapt to today? So if a deal comes across your desk, are you just saying there's no rental increase for 2 years and then going back to standard rental increases? Are you doubling up on your typical reserves? What are some of the best practices you would advise investors to use?
You asking me?
Yeah, sure.
Everybody. Okay. Well, yeah, I mean, we never did the 3% rent bumps. We did, I think Robert, my partner that does most of the, he's the CPA and the analytical side of our company. And 2% was where he likes to be in the past. Right now, we're not anticipating any rent increase the next couple of years. So that's what we've done. I'd love to hear what the other guys are doing.
Well, if someone bring me a deal, first question is it post-COVID price or pre-COVID price?
Well, isn't the answer always going to be post-COVID price?
No, they are saying it's pre-COVID. Then I said, it's okay, forget about it. Don't talk.
How much less is post-COVID price?
Well, I expect at least minimum 10 to 12% minimum, because if you look
there's a disconnect there, right? Sellers aren't taking that right now.
Well, yeah, it is what it is, because
we got it on these 2 deals we've got going. We got concessions. So.
Yeah. And I'm seeing deals 12% above, discounted right now. So it's not like we are not seeing it. It's just, because the lower investor sentiment, there is no application fee, there is no late fee. The NOI drops already, right? And your mortgage, you have this reserve in front of it, right? And after that, you do not know even whether you can raise the money, right? So there's so many things that is, we are in a buyer's market right now. That's what I feel. So, and at least 10 to 12% from what you used to pay is maybe a more safer bet to buy, because there is not much of data on the market pricing right now. So, but I would take any deals which is like 20% off.
You and everybody else, James.
But I need a seller who's going to sell that, right? So
you are a tough nut, James. I will tell you.
Well, because no one knows what's going to happen. How do you know the cap rate is going to expand, right? Because usually real estate, if you look at real estate, it takes like 3 to 6 months after the Dow drops, because now, your class B and C is going to go back to work. And not everybody's working, right? So second of all, if you look at it, all the big companies now, they have realized that, the whole world is going through COVID-19. There is a recession. So now all their profit is going to come down, right? So now all the big companies, especially the people who are staying in A class and B plus, now they're going to say, okay, we're going to start laying off people because our profit has dropped, right? So now in the next 3 to 6 months, I think you're going to be seeing more layoff on the higher side, higher income side, which means, we're going to go into a longer recession. I don't think so. This is a done deal, right? I think it's going to be another 3 to 6 months of going down. So no one knows what's the price. So that's why I'm saying 20% lower or at least 15% lower would be a good, safe enough price for me to buy. I mean, lower means lower from March price, right? So
unless they were 20% higher before.
Yeah, it could be. Yeah, and you do not know even the rent that you're projecting, even though you say 0% rent. Is it 0% from where?
I mean, not just that. You could have negative growth.
Yeah, you could be negative, zero, negative, right?
Sure you could. In
So
fact, you should anticipate collection issues because they're going to happen. To think otherwise is naive, frankly, with COVID.
Yeah.
So,
But look to
that's-
what Bill said, though. I mean, there is a flight to quality as an example, nicely placed assets.
Yes.
In good school districts, as an example. Look, we've got this one deal in Fayetteville. It's a top-ranked school district. And we have no problem not only just filling it up, but again, weirdly, this is still very weird. We're able to, even as of like this week, we're able to push rents up $200. And we've been able to fill some up. But again, I realize this is obviously not an average across the market. This just might be a one-off thing for our asset. But the same is not applying in the other assets we have, which are not in as good of a school district. So you understand these are small little things that are happening, but you will have, and you are having a flight to quality, where even if you have the same rent, but let's assume you didn't even push rents, but you pushed up occupancy all the way up, and you didn't have as many collection issues, that still means that there's more cash left for you to collect, right? So quality, as Bill said, is going to have a big difference.
Omar, we're seeing that too, just a high demand for our units. We're 100% occupied right now.
Are that the one in Lithonia or where?
Yeah, in Lithonia, 100% occupied. There is starting to be a delinquency. It's not an issue. We're 94% economic occupied, but the notice to vacates are all 6 weeks out. Like we can rent them up 6 weeks out.
Yeah.
So it's just like there's no concern. We can start to see in that asset just a slight delinquency, but at 100% physical occupied and 94% economic occupied, everything's fine.
I mean, look, there's always a concern, right? Even in good times, you're always concerned because you're good stewards of capital. But if you've got a good, nicely placed asset, good foot traffic in that area, you're always going to be in a better position than something that's
agreed. But you really need to take a hard look at what the employment base is in that sub market and see how recession resistant it is. And we've just been studying the employers that are employing the residents in these assets that we're buying. I mean, literally one by one. Okay, how many work in a restaurant? How many? What sorts of, and doing the homework on those larger employers as well. Okay, one works at Delta. Well, they just announced they're going to lay 30% of their workforce off. So those sorts of things on a micro level, but on a macro level, if you're looking at an asset, you better be looking at what the employment base is. There's a lot of retail, a lot of restaurant. That's what sunk me in 2008. Most of my residents were in contractors. They were plumbers, electricians, drywallers, roofers, painters, which fell off a cliff in 2009. And so, it's so important to pay attention to that. I don't know if you guys agree or not, but that's
very important. By the way, there's a question from Whitney. Dylan, you want to take that?
Yep. And I was going to say, Bill, I think you started to speak, but I think you might have been on mute. I didn't know if you had anything to chime in on that.
You've been on mute.
Still on mute. Sorry, no, I didn't say anything.
You probably said the most amazing thing.
You didn't catch that? That was brilliant. No, I didn't say anything.
Okay.
Sorry.
Good. Okay.
No, I was probably talking to myself.
Okay. You might have been. Okay.
Yeah, that's why I wear AirPods in public. So
Double checking.
You don't look crazy that way.
Awesome.
Yeah, I think a lot. I don't know. I'm gonna say something. Okay, let me just continue. So guys who were in trouble before COVID, they are in really trouble right now. Right. So guys who took bridge loans, who thought that 3 + 1 + 1, now they realize that the 1 + 1 is actually lender discretionary. They never. A lot of them didn't even know that 3 + they thought they have 5 years. Actually, they forgot that 3 years is yours. The other 1 + 1 is actually lender. So most lenders are not giving that 1 year additional, right? And if you look at it this way, a lot of people did bridge loans to do deals at the market peak, right? And now what has happened is bridge loans they have this reserve and they have this DSCR, which is pretty low because now you're doing a value add, right? And when you are doing value add, you're slowly getting the rehab money so that you can increase the rent. So I don't think so any bridge lenders releasing any money because they are in trouble by themselves. So now the guys who took bridge loans, their DSCR is still low. At the same time, they are not getting any money coming from the lenders, and they're not going to get extension. So they are going against a hard wall here, right? So that's a lot of guys.
There's going to be some pain. Those of you that don't know what DSCR is, it's the debt service coverage ratio. Quick example: it's an annual number based on the property's ability to service the debt. And it's the difference between the net operating income and what the debt costs. So, for example, if the net operating income is 100,000 or 125,000 and the debt is 100,000, that's a 1.25% debt service coverage ratio, which is the minimum that commercial lenders up to this point would accept. But the other thing in lines with what you just said about bridge debt is, a lot of them were CMBS based, and they're gone. They're already gone. They're out of business. And I don't know if you guys saw the CoStar article talking about. I know you had the rep from CoStar on earlier. I'm sorry I missed that, but they did an analysis of all the CMBS debt, and they determined that 13,000 commercial loans they're pretty sure are going to go into default and not recover. So 13,000 loans is a lot of loans. And this was a month ago when that article came out. It's probably worse now, but that's on the CMBS side. So
yeah, I think July once the unemployment checks runs out is where the lifeline is let go.
Yep.
Hey, so just on that point though, guys, what do you think? This is an election year. So I'm also thinking nobody's that
more money.
Yeah, I mean, look, I'm not saying it's right or wrong. This is not a political comment, but this is an election year. And no party is going to stand for their principles and lose an election. I mean, come on, they're politicians.
No, there's going to be more stimulus.
Yeah.
And I heard a very interesting interview with an economist named Howard Marks, and he's notable because Warren Buffett has publicly said when he gets a memo from Howard, it's the first thing he reads. And Howard said, we were already trillions in deficit before COVID hit, and we didn't have inflation yet. Now they've thrown trillions more in. So it's going to be real interesting to see how far that stimulus can go in before it really negatively impacts us with inflation as well. So, I think you're right, Omar. Because of where we are in the election cycle, there's going to be more money. So hopefully it's enough to, not have the.
See, like my criteria is now it's just a race between does the economy recover quicker, or we at least perceptionally are we back to thinking the economy is recovering quicker, or do we just run out of ammo? Like, which one is it?
Well, the Fed has said they've got unlimited resources, but basically their printing press is able to run as much as they want. So, they're positioning themselves as if more money is coming. So, we'll see.
Whitney, do you want to unmute yourself and ask your question?
Yeah, I actually have a couple, but I won't ask them all at one time. So I hear you guys talking generally about the market and everything, and you want to see great deals. But so overall, are you guys being aggressive right now pursuing deals, or are you guys sort of waiting until this storm cloud passes over and thinking that there's going to be more opportunities in like Q1 of next year?
I'm in contract right now, so we're active looking, and if the price is right, we will execute, but that's hard to find right now. But I think if you just say we're always looking for the better deal, you might actually miss a deal that comes and hit you in the face right now.
That's a good point.
Yep. Agreed with that as well. I mean, we were under contract before COVID on these two assets. They've been delayed because of debt. But do I think there are great deals coming, Whitney? You better freaking believe it, okay? I really believe. In fact, there was just an article in Business Week last week, smaller landlords in New York, of course, with the rent control baloney, or not rent control, rent concession stuff. The people in the blue states right now that have gotten more concessions as far as rent, those landlords are sucking wind. And it was just an article titled "The New Real Estate Crash," I believe was the title of the article, and bemoaning the fact that their renters have nicer cars than they do, and these small people that have anywhere from 10 to 30 units. And so will the agency, the assets with agency debt, have a lot of distressed assets? I doubt it, but the bridge debt, like James was just talking about, bridge debt, and these smaller assets, like under 70 units, I think there's going to be some incredible opportunity coming. I don't know if you guys think, and that most of the operators on this call don't do those smaller doors, but I think for those of you just getting started, I think you couldn't be learning this business at a better time.
I did see one scenario. It was a market that I wasn't ready to enter in, so we didn't go for this deal, but it was like everybody's looking for distressed deals, but there's also a situation out there where you have groups that own 10,000 units and they just might recycle some capital right now. So they bought it 30 a door. It could have been sold for 100 a door maybe 6 months ago. Now they'll sell for 70 or 80 a door just to recycle capital, and they still make a fair amount of money. So if that's not a distressed deal, So you just have to be at the right person at the right time. We didn't enter a certain market because we didn't want to enter that market. But I saw something that was 1993 built that I would have thought it felt like 25% discount. And I was wondering what the red flag was, but there wasn't any.
The bigger groups could just be taking chips off the table too, right? And just have like a set allocation for each asset class.
Or
Right?
getting into cash, guys. When they see the writing on the wall, during a crisis, cash is king. Your ability to raise cash, have cash available, and so I think there will be an opportunity for distressed assets at cents on the dollar at some point. Certainly in the smaller size properties, the CMBS stuff, the bridge debt, those when those go into receivership or special asset, there's going to be opportunity there. So, are we still looking, Whitney? Yes, if the deal is right, but we are also, looking at the expression is ethical opportunism. Okay, it's horrible what's going on right now, but we're compassionate capitalism, I think are the words of the day.
Hey Whitney, I'm a complete vulture capitalist. You can send me all your deals. I have no problem.
Yeah, we are not as
No problem.
nice.
No problem.
Nice
Rod's
as
a really nice guy.
All right,
Me and James will look at it. No worries.
I forgot who was on the call.
Rod is a really nice guy. James and I will look at it. Don't worry about it.
I'm launching a real estate rescue fund.
I got a question.
So yeah, we are basically. I'm not really aggressively buying this, because I do not know what the price is, right? I know we can say the deal is good based on what, right? The price is right based on what. There's no market being established right now, so we can't really say what happened in March. The price at March, even though 10% from below March is a good price, right? So it's all speculative right now. So
but it also depends on the market you're in, right? Look.
Yes.
Yeah, absolutely.
There are lots of other factors at play, in my opinion. But overall, that's very common. That's very sound strategy is to wait and see. But again, there are a lot of factors.
But don't sit around waiting and not doing anything. Waiting is an excuse for everybody just to sit around and be like, but I didn't do anything and then I missed it. Be active while you wait at a minimum so that you can understand what a deal actually looks like instead of being surprised by it and not knowing what's going on when you try to get in.
Yeah. And nobody can time the bottom of the market. I mean, you only know that once, like 4 years after the fact that what was the bottom of the market.
Bill, I want to hear from Bill as well. As far as I know, you've been saying that the prices are high and waiting for it to come down for a while now. What's your overall take on where things are and what have you guys been up to lately?
Yeah, so sort of answer Whitney's question, we are underwriting aggressively. We are looking at deals aggressively. We're just not offering aggressively. It's a big difference. So our offer is pretty much going to be about a 6.5 cap on a quality asset on in-place NOI. So that comment just burned 20 points off the market value right there. Almost any deal you underwrite, if you make an offer without raising the rents, without coming up with some kind of willy-nilly pencil whip pro forma, and you just make an offer on the NOI, almost no deal makes sense out there right now, which says to me you're a solid 15 to 20% in false valuation in the market. So we're just going to offer and go ahead and correct the market. Does that mean we're going to get deals accepted? Probably not. So are we sitting on the sideline? Maybe, but not functionally. We're just going to be forced there.
So you're the same number as me, I guess, right? 15 to 20% off.
Exactly, all day long. Yeah,
if you get it, it's get it. If you don't get it, that's okay.
I personally, and this is exactly, and being in the education space, let me say something blasphemous. We've created a syndication bubble. There's absolutely a syndication bubble. We've turned out too many students. They've overbid in assets they shouldn't be in. We've bought a lot of assets on pro forma, and it's overvalued the market, and it's made sellers have false sense of security about the value. And so when that pulls back, it's going to be a nasty sucking sound for a short amount of time, and then we'll get back to reality. I've been through this cycle already. I've done this before. I'm just going to sit tight. I will look for a motivated seller that owns a good building, and I'm going to sit tight until I find it.
But Whitney, even in good times, it's a numbers game because you could be really, really confident about 3 deals, but if those are the only 3 deals you're ever bidding on in the whole year, chances are you're not going to do any deal. So it's still a numbers game, even during good times.
Exactly. And that's the chances that we're not going to do any deal because I would rather do no deal than a bad deal.
Yeah.
Especially when it comes to somebody else's money or investors' money or students' money.
Raj, do you want to jump on and unmute yourself?
Yes, Dylan. Yeah, a couple of questions to directly to Omar and my friends on the call. So, what markets are you going to be focusing after COVID? And is the preferred returns are going to change? Right now, a lot of people from the last 4 or 5 years, they've been offering 6% to 8% preferred, and the IRRs around 18 to 19, from 15 to 20. So how things will change, I know it's based on data. Right now it's uncertain how it is. So it's a loaded question. I have a couple of questions. That's why I'm asking, so that it's more of an investor perspective I'm asking. So how is it going to change? Is multifamily is going to be in the same level moving forward? Since it's uncertain, what are the things that you're doing, since you cannot increase the rents, how are you going to underwrite moving forward, and how are you going to adjust, and is the cap rates are going to be more,
Well, see, I don't know the answer to all of them. I can tell you I'm going to be in the same markets that I was before, purely because a lot of people think you can just jump and go to, say, if you haven't been to the Carolinas, you can just jump and go to Carolinas. And it doesn't really work like that, because you got to know the brokers, you got to have a relationship. Because think about it this way.
Absolutely.
Why would a broker, I mean, look, they'll talk to you, that they're in the business of talking to people. But look, if somebody's worked with the broker for 10 years, they're a known entity in the market, why would they not take a deal to that guy or work with that guy first, then some random guy decide to show up, right? So I'm going to double down on the markets that I'm in. Look, the secret with pref is whatever you offer, the lowest pref that you can get away with, okay? Because nobody wants to offer more money. Okay, let's just be honest. Nobody's dumb enough to give you more money when they can promise you less, and then it's easier to meet that hurdle, right? And where things are going to be in 5 years, frankly, I have no idea. I don't have a crystal ball, but I also didn't have a crystal ball 5 years ago. So nobody has it. So where are things going to be in 5 years? No idea. We can only go off data points that we have right now and take the best decision with the information we have right now. Some of the points Rod mentioned on employment, Bill mentioned on, quality of the asset, and James mentioned about being the complete vulture. They all apply.
Sure.
But James has always been a complete vulture, though. So that.
But yeah. I really empathize with James' line of thinking. That's why I love James.
I love it.
Yeah. Well, you have to be like Howard Marks, right? What you said, right, Rod? Warren Buffett listened to Howard Marks. He's a complete contrarian.
Mm-hmm. Yeah.
Right. So
exactly. Yes. Howard, Warren definitely is a contrarian.
Yeah.
And when there's blood running in the streets, that's when you pound. Yeah.
I got a question for James and Rod, and Vinny also said he was in Austin too. So, what about the Austin market that makes you want to invest there? Is it rent growth, population growth, jobs, or all three?
Population growth, rent growth, all are awesome. Appreciation's growth, but you can never get a cash flowing deal in Austin. Right. I have one deal in Austin, which is cash flowing, which is good, but maybe I should take that back. But it's really, really hard to get a deal that cash flows in Austin. Austin is, if you look at it, is the best market before COVID. And I think that will be the first market to come back up. In fact, we don't feel anything here, right? I'm in Austin right now here. In fact, I think it's going to be just much more stronger with Tesla coming in here, right? I mean, Apple's being built right now. It's just a tech city, and it's in Texas. It's just going to be really strong. So it's hard to find a deal that cash flows. I was trying to buy deals in Austin at $40 a door 4 years ago. Just 4 years ago, $40 a door.
Oh, wow.
Right, and I can, even at $40 a door, I can never cash flow. And I went to $60 a door, I can never cash flow. And I keep on, I say, I need a deal that cash flows, right? And we went to $100 a door, I bought one, and now it's all like $120, $130 a door, right? And which is still cheaper than some of the other cities, right? Some cities are really expensive, but Austin is a good market, but don't expect cash flow here. It's appreciation.
It's a phenomenal market, but to find the deals is challenging for sure. We don't have a footprint there, Rashad. I just interviewed a guy that's got assets in Austin. That interview is going live on Monday, but nice guy.
Yeah. I mean, a lot of people who does deal here, they expect the cap rate to compress, and the exit cap rate is compressing, and that's the only way you can make the numbers work.
Chris, you want to share with us a little bit about the Great Relocation and what we should know about it?
Yeah, it's my belief that you're going to see an exodus from some primary dense cities, continuing a trend that has already been happening from, say, like New York moving down south, or California moving to, say, Phoenix. But this COVID situation where everybody's cooped up in their house for a long time in densely populated areas where you can't enjoy the air, I think you're going to see that continued trend, and people are going to want their yard. And I don't think that the southeast markets really understand what's about to hit them with everybody moving there. There's just a lot of brokers I'm talking to that are saying, a lot of New Yorkers, New Jerseyans, Connecticut, Boston, places like that, Chicago, they're like, we're done. This is it. We're out of here.
Bring him on. Come on down.
Hey, man, come to Atlanta.
We'll leave the light
please.
on. We'll leave the light on for you.
Please come to Atlanta, to Fayetteville.
I think
Everybody can move there.
Texas, Florida, and Georgia will be the benefactor.
Yeah.
I mean, they have always been the biggest relocation, right? Just going to be more, I guess.
There's going to be more. And I think you're going to see more of like the concentric circles outside of these secondary cities like Charlotte, Raleigh, like those areas that are considered tertiary, and you should be very cautious about going into those areas. I would just keep an eye on them, because you might see the concentric circles coming out of the secondary cities, making those more robust.
That's very sound opinion there, brother. Yep.
Yeah. And if you've seen the eviction moratorium by the city, you can see whether they're landlord friendly or not. So that's going to be another factor when you look at submarket, which city within this, great states, which is going to make it a difference in terms of more investment and more people moving in.
Also, I mean, it gets political. I can't believe it's gotten political, but it's like those areas that opened or closed latest and opened up soonest from an investment perspective. Well, one would say like, okay, if I'm quarantined longer in areas, my capital is more at risk. Mm-hmm. So that's becoming a new marker.
So Chris, when are you moving from Long Island, man?
Yeah, I'm in the epicenter. I'm on the east end of Long Island.
Come on. So when are we seeing that great relocation happen down south?
I'm getting ready. You'll see something soon. Don't worry.
Okay.
We're out of here.
Don't go to Philly though. That doesn't count.
All right, Whitney has another question here. How have you changed your operations to accommodate the new reality we live in? Multifamily is heavily tied to employment. So are you guys doing anything different to any of your properties? Are you seeing unmanageable delinquencies at any properties, and how are you adjusting?
I'll jump in for a second. And this is something that all the good operators are doing. Obviously, as far as management, it's over communication. It's finding out really where your residents are, how many have lost their jobs, how many need help, working with them if they've paid well up to that point, being accommodating, and recognizing that this is temporary in most cases, and not losing a good tenant because you were inflexible through this process. So I don't know if you guys want to add to that.
We're doing similar things. We definitely worked out payment plans. We also offered discounts, one-time offers sometimes to clear bad debt, because there was stimulus checks coming in. Like this is your opportunity for a percentage off to clear the bad debt. And we had a fair amount of takers, and the residents were appreciative of our, number one, our proactivity, number two, our communication, and just that they felt like we were working with them. And that's about community development too, which should be on everybody's. It should be everybody's thesis as part of an asset manager, to build your community.
And I'll add that. That's what we did at Broadwell. We kind of immediately reached out to all our tenants and tried to suppress the tenant versus landlord attitude you get when people get upset. And a lot of times tenants sort of have that point of view about landlords in the beginning. So we opened up immediately and said, hey, family first, relationship first, and we want tenants in their homes. And we want relationships. We are working out with a few tenants, but so far, no unmanageable debt, no rent strike or anything of the nature. So far, so good on our end. We'll, call me back next week and we'll see if I have a different opinion then. But so far, so good. Again, I think like Chris saying, it's really about customer service and letting the tenants know that you're not just a profit monger at the expense of everyone else. And I think that's helped us collect our rent so far.
Guys, and it always pays to be nice. in life, period. I mean, look, you shouldn't be stupid, but it always pays to be nice, easy to work with. You shouldn't have your daggers drawn all the time. A lot of people come in saying, I want every last dollar. And yeah, you can get that, but you burn so many bridges in the long run that, it's just bad blood everywhere.
Yeah, I've seen a lot of management companies come out with a very aggressive message. You're going to pay rent by God or hell or high water kind of message coming out quickly when the lockdown hit, and I think that's turned out to be a mistake for operators.
You better believe it.
Exited out like that.
And Bill, that's coming from unfortunately, a lot of owners putting that pressure on property management companies, and that's just wrong.
Yeah, Chris, but the other point also is that sort of like mafia-like tactics, they don't really work anymore. Back in the day, you could maybe shake people down for money. I don't know, I'm assuming. Yeah, that stuff doesn't really work anymore. People are a lot more aware, and nobody's just going to be shook down for money.
And
so
Google,
it's better.
Google reviews.
Yeah. So it's better to always, not be stupid, but, to be like, look, this is a service. We want to make money, but I don't want to throw you on the street.
So between this panel and last panel, we've touched a bit on debt, and we know some of the limitations we have on the debt side of the world. But how about as far as equity is concerned? What are you seeing with your equity investors? Are people a little bit more fearful right now? Are they reluctant to invest? I know a few of you guys are transacting right now. Are you getting pushback and having to deal with that?
Flight to quality has helped us. There's definitely concern, but there's also the very near term recent feeling of having no control in the stock market and being like, I'm like, for a while, actually, during the good times, it's like, yeah, but the stock market's great. Now it's, I gotta diversify even more. So there is a willingness. There's fear, because we're in a place of, a lot of people are in a place of fear, but you counteract that with your track record and your business plan. And they know that they're in hard assets and they want to be there.
Yeah, agreed. We had a little we had fear a few weeks ago, and especially with the stock market volatility.
Did you have anyone pull out, Rod? When
sure. Yeah, sure. We had a few pull out for sure. I mean, they got crushed in the stock market, or just got sucked into the fear, and the fear is pervasive right now. And guys, I want to say this to you, those of you listening. I said this morning, that you choose what you focus on, and whatever you focus on grows. And if you choose to focus on CNN and Fox and ABC, you're gonna have more fear in your life. So it's so critical to manage that. But you tell that to your investors. You let them know not to be fearful, but you can't influence everyone. But if there were a time to pre-frame your investors, it would be right now, and it would be to say, hey, multifamily has been a solid asset through market cycles like this before, and so look at the stock market. Is the stock market getting a bailout? No, but you're seeing lots of help in the resident in the housing sector. So keep that in mind, but don't succumb to the fear. That's what we've been trying to communicate.
Are you guys looking at a longer timeline as far as the horizon on any deals that you're looking at right now?
Yeah, I would say look at a solid 5 years or so. And, I would be extremely nervous if I had a planned exit strategy, a refi or a sale within 12 months, 12 to 24 months, and any kind of refi in that window, I think is going to be a highly risky scenario. And I'm warning all my students about getting into deals of that nature. Yeah, it's going to be tough if you have to get out of a deal in 12 to 18 months. I think that's risky, and I know a lot of people are trying to do that, and that makes me concerned.
Yeah, no way. Yeah, no way. We've always done 5-year horizons on our projections, but especially right now, and no debt that comes due short term either.
Right, there you go. Yeah,
you've been saying that for a long time. No short term debt at all.
Yeah, that was one of the big mistakes I made in the last market cycle. I was getting 3-year loans, and I had a 3-year loan come due at the very bottom of the cycle, and the bank had actually gone bankrupt and been bought out, and the incoming bank had an 80% loss share agreement with the FDIC. So they didn't call my mortgage; they just didn't renew. And looked me in the face and said they had, they could write off 80% of the loan, and didn't bother them a bit. So they were not my buddy that day. They were not my friend. And
so I had a bad day.
Yeah, right. I had a forced exit strategy, and that made me a motivated seller. You don't ever want to be that. You want to find them, you don't want to be them. So
Well,
that short-term debt will really get you. You got to watch those market cycles.
Well, also, like you said, if the note is coming due, you have the other situation where multifamily is such a desirable asset class that the note going back to the note holder, everybody says like note holders don't want to own real estate, but they do want to own real estate at 70 LTV.
Yeah.
Multifamily.
Banks don't, but other lending, certainly environmental, other lending,
Like
bridge debt for sure.
I would agree with Rod completely. Yeah, not all bank lenders, but Tony Morgan and I have actually run into a lender not that long back that was being extremely predatory with taking over a property. Not a traditional lender, but Rod's spot on with that. Be careful.
I've got a student that had a bridge debt approval all the way through 2 days before closing. They yanked the plug. The bridge lender bought the property. Now they settled. They settled. Yeah, but talk about predatory. You want to talk about predatory? Yeah.
Wow, what kind of scammy operation was that?
Right. No, I know. No, but yeah. So
yeah.
But the definition of a bad day is to have an asset that's cash flowing, it's beautiful, and have your cap rates go up and you're not able to refinance because you're at the bottom of the market cycle. Like Bill, that's bad.
It cost me money that day. Yeah, it was a bad day. But you live through it. You live and learn.
Yep.
So.
That's it.
And now we're here to share it with everybody else. So
yes, sir.
I try to make positive out of it.
So we have a broad audience of all different experience levels, but for those that are starting off in this environment, what would you recommend?
Education for sure. And I mentioned this morning. I've got a 2-day boot camp for $97, and we're not selling anything. July 25th and 26th. If you're serious about this, educate yourself so you don't make a mistake. And it's multifamilyvirtualbootcamp.com. I hope you come join me. And that's I know that's self-serving, but it's the truth. Whether you come see me or not, educate yourself, because I truly believe an incredible opportunity is coming, and especially in the smaller stuff. And smaller, I mean, under 100 doors. There's hedge funds that are gearing up and building funds right now to take advantage of the larger distressed assets that are coming. So, learn this business. I had 900 people at the one I just did 3 weeks ago. So I'd love to help you. And again, not selling a damn thing. So 16 hours of training. Other than that, I would get in as much cash as you can, access to cash, talk to everybody that'll hold still long enough and let them know what it is you're doing. So that, because it's, to buy these assets, it requires money, but it doesn't have to be your own money. So, those two things, education and access to cash, and you'll be able to capitalize on what's coming.
And you have to be talking to people all the time about your vision. You don't just get your deal and then hit everybody in the face with a cricket bat and wonder why they're not investing with you. You gotta be telling them about what you're doing, why I should have coffee with them. They gotta believe in you. You gotta know what you're talking about. And then so that when talk about a deal that you bid on and you don't get, and then tell them why you didn't get it. Maybe you wouldn't go to a certain price. And then they'll say, when you get the next one, I want to get involved with you. You always got to be talking to people about what you're doing.
This business is a team sport. You build relationships, and it truly is. It's not like single family. I know many of you probably do single family. It's not like that. This is something you put a team together, and that's one of the biggest benefits of this business, because you can bring in the equity, you can bring in the at-risk capital, the earnest money, things of that nature. You can bring in the asset management, the experience, the net worth, the liquidity. Somebody brings in their balance sheet. Everybody gets a little piece, and you're able to put this thing together. And it's a beautiful thing about this business.
Yeah.
But it's all relationships, like Chris said. You need to be continually building them, and they're just friendships. Really, that's how you look at it.
Yeah, I would say just be prepared for the next 3 to 6 months. There are going to be opportunities available, but you need different tactics, right? You can't be like, let's go and partner, let's go and build a relationship with brokers, right? So you want to look at, off-market direct strategies, right? Because there are going to be a lot of sellers, similar in single-family homes. There's going to be a lot of sellers on the multifamily as well, right? Especially on the smaller side, as what Rod says.
And you've done a few direct market deals, right? Direct seller deals. What strategies have you used in the past?
So I've used like text blasting, even yellow letter marketing, cold calling as well, and it works during this kind of times, right? Because most sellers either do not want to list their deals, or they don't trust the broker, or they just want to take it slowly. So this is the time to do all that and look at different strategy. Like, for example, I mean, rather than just go and buy a deal, that's the boring strategy, just a normal purchase. You can look at master lease. You can look at seller financing. You can look at different creative styles of transaction, right? And this is the time to do all that. You can't do all that strategy during the pre-COVID market peak time because everybody leases with a broker, right? But during the downtime, you are looking at different strategy. And this is people who employ this kind of strategy are the ones going to come up really, really well. I mean, these are the people who are going to get like 15 to 20% off if they know how to use this kind of strategy. If you want to do this, the normal buy, I mean, every broker is going to do best and final and best and best and best and final. And you are like same like pre-COVID. In fact, you're probably worse than pre-COVID because now the investment term, the loan terms are worse, right? So yeah, people have to really do all the strategy, learn underwriting, make sure you build all your passive investor list right now.
James,
This is the time to do it.
We have a mobile home panel going on at 6 o'clock, and I know that's what they're all about, right? We have one of the best brokers in the country there, and they're doing all kinds of strategies to build their list, to direct mail, to cold call, right? And we get lazy and complacent in multifamily sometimes and just want to sit back and wait for the brokers to provide us with the deals. But definitely, I totally can second that. If you can double down and learn direct marketing strategies and put the systems in place, it'll give you a huge edge, especially if you're dealing with the deals that are less than 100 units. I think that's probably the most up there.
You'll have a lot more openness to seller financing, like you said, James.
Yeah,
like
exactly.
Like they don't want the tax consequence. They actually want the cash flow now. Like now it's cash flow is more important to me. I know the banks aren't going to make this happen, and you're just going to see a lot more openness. Don't be afraid about the seller financing, getting shot down.
Guys, there's just one point I wanted to highlight. Rod made like the best point, I think, right at the start. A lot of people think you don't want to start in a down market. You want to start in a down market because there's chances are you can make a lot of mistakes, but because the prices potentially can be down, they can cover up for a lot of your rookie mistakes.
Yeah.
And then by the time the upcycle comes, you're a seasoned operator, you have a track record, and in an upcycle, anybody can then make money, right? So that was a great point by Rod.
Thank you. More than anything, guys, don't freaking wait. It's coming. Trust me. I mean, this is deja vu for 2008, 2009. I think it could be bigger than that. So get educated, get connected, build your team, and be ready to capitalize on this because it could be the greatest transfer of wealth we've ever seen. It's been said that it's going to be. Who knows if that's true? But there's no question there's going to be a lot of opportunity.
Yeah. Forget about all the parameters in March. Forget about all the prices that you had in March. Forget about the rent growth you had in March. All your underwriting, all that throw away. This is a new cycle. If you're not getting a deal on the new parameters, that's probably not a deal. You're probably buying an old deal at the wrong part of the cycle, right? So don't buy a pre-COVID price on a post-COVID term. You'll be
but this is where, but just one thing though, this is where knowing a certain market as opposed to spraying and praying, right? Where when the times are good, you can pretty much go to any market. Every market's going up, so you can kind of figure it out. This is where it's going to become really important. Let's assume you're an Atlanta native, so you know the parts of the city. You are at at such a big advantage. Or somebody say who lives in Texas but wants to invest in Atlanta, or the other way around. Knowing your market at this time, all the small little things that you learn and you assimilate over a period of time, that's going to become extremely, extremely important now.
Bill, any last pointers from you?
Yeah, no, I think I pretty much largely agree with everybody. Now is a great time to get started. And as Rod said, you certainly want to start with your education. But it's like I tell everybody and all our students, it's a great time to get started because you're not going to buy anything anyway. It's not like you're missing any deals. It's not like all the hot deals are flying past and you're really watching the world go by. This is a wonderful time to get in, to learn, to get your team together, to get your equity team together, because you want to go into that cycle, as everybody sort of mentioned, with your team and your capital in place. So I think it's a great time to be getting that education. And it cuts down on people that are new to the business, I think, getting too easily into deals. And that can be a problem, people getting in too easily, getting into deals they shouldn't get into. So I think a barrier to entry is actually a little bit good right now.
Sure it is. Yeah.
Earlier, James mentioned that he uses SMS and direct mail. What unit size are you seeing that work on? What unit size are you
It
getting?
works for unit 20 to less than 150.
Okay.
Absolutely works. You just need persistence.
Consistency.
Persistent, yeah.
Yeah.
Persistency and
It's all a
consistency.
timing thing, right? You just got to catch them at the right time and keep
That's
following
it. It's
up.
all about motivation. Got to get them at the right
Yeah.
time. That's all.
Yeah.
That's everything.
Yep.
What
Yeah,
platform are you using for SMS blast?
there's a platform called SMS, Excel SMS. You can use that, but nowadays there's so many platforms out there you can use for text blasting. I get a lot of text blasting nowadays. You know,
Me too.
5 years ago there was no text blasting happening, but there's just not many people who are persistent. So if you are persistent, you should be able to get deals.
I know we have. I don't know if Rafi's still tuned in because he was over in Tel Aviv, but he's got VAs that are texting all the time, and he's got great systems in place. So yeah, people are doing it, right? So I definitely recommend putting the systems in place, get the text messages out. Text messages cost virtually nothing. They're so cheap and so easy to do. So if you just put the systems in place, it'll work for you.
Yeah,
So
yeah. But I mean, let me just clarify something. So there's a lot more things than text messaging. I mean, there's also finding the lease, finding the decision maker, and how frequent you text and what is the message you're texting.
Right.
And when they call you, how are you responding, and whether you are a person of credibility or not. All that matters, right? A lot of times I get a lot of text messages, calls. When I talk to the person, I do not want to talk because they're so newbie. They do not know what they're talking about.
Yeah.
So you have to really get educated on being a really good underwriter of multifamily. So when you talk to someone, people are going to really respect you because a few sentences that you mentioned, they're going to finally see through you very quickly, whether you know what you're talking about or not.
Totally agree.
Right.
Well, James, I saw you threw your contact or a way for people to reach out to you in the comments here. If everyone wants to just go around the group and just let us know what's the best way to contact you and connect with you, or if you want to post it in the comments, that works as well.
Yeah. I mean, guys, again, $97. Come see me for 2 days. I promise you'll be glad you did. If you don't freaking love it, reach out to me. I'll give you your money back. But it's just total training with no sales. I'll also put my website on here because I've got a ton of free content, books and videos and articles and all sorts of things that'll help you learn this business. And of course, my podcast. If you're not listening to that, I hope you will. I think you'll really enjoy it.
Excellent.
Yeah, if you guys want to reach out to me, my website is Achieve Investment Group. Achieve is like achieving a goal, ACHIEVE, achieveinvestmentgroup.com. My email is james@achieveinvestmentgroup.com, right? Yeah, you can find me everywhere. I'm an author. My book is Passive Investing in Commercial Real Estate. One of the best-selling books. We have sold thousands of it right now. It's a really good book for passive investors and also newbies starting because there's a lot of terms that I explained it in which a lot of complex term which I've explained in a very simple English, right? Yeah, I have my own podcast, Achieve Wealth Through Value-Added Real Estate Investing, which I interview a lot of operators. So if you want to really learn the technicality of the business, you can learn that. And LinkedIn and Facebook.
So guys, you can reach me at OMAR at boardwalkwealth.com. Our website is boardwalkwealth.com. I've also put it in the chat window. So if you have any questions, anything I can do to help, I'd be happy to do that.
Chris Jackson, you can reach me at our private investment company website, sharplineequity.com. And then we're also coming out with a new multifamily analyzer that we're really excited about called themultifamilyanalyzer.com. A confused mind says no. So synthesis is going to take away the confusion, and it's really going to allow you to up your underwriting game. And just like James mentioned, if you can start to underwrite and understand what all these pieces are, you're going to be able to talk to sellers with more confidence, and you're going to be able to talk to your partners and raise money more easily because you understand what all the numbers mean on how to structure deals.
I got a question for you, Chris.
Yes.
There's a lot of deal analyzers out here. So what
Yes.
makes synthesis different from everything else that's on the market?
So a lot of the analyzers are either too simple and they don't give you what you need, and they're not really helping you make a informed decision on an offer. Like say you have a property that's a heavy value add with a refinance component.
Mm-hmm.
That's just there's not a lot that give you that robustness. Then if the ones that do give you that robustness are too complicated for you to underwrite quickly so that you can make enough offers and get close enough to understand if you're wasting your time, and this analyzer will.
When are you going live and how much is it?
It's themultifamilyanalyzer.com. It's going live at the end of next week.
And how much?
$197.
Oh, that's good, buddy. That's good.
There's going to be videos on how to do.
Hey, can you ping me? I'd like to chat with you about it.
Yeah, sure.
Okay. All right.
There's going to be videos on how to do basic underwriting, and then you can go to various education programs to learn how to underwrite and learn all the terms. If you don't know what NOI is, you probably want to learn that first. But but everybody wants to level up very quickly when they start underwriting, and then a lot of the analyzers are lacking, and this is going to help you up your game.
Awesome.
I'll give my email last. It's Bill at Broadwell Property Group, and our company is Broadwell Property Group, and the website is broadwellpropertygroup.com. Checks out.
Pleasure to meet you, Bill. I think I knew everybody else, but it's nice to meet you,
Yeah, nice to meet you as well.
Yeah.
Hey, I'd just like to give a shout out to Clive Davis. I just saw him right now. Hey, Clive, I know we didn't meet in Atlanta, but next time I'm there, we can meet from 6 feet apart.
Mask on.
Yeah,
That's an iconic name.
that's what I told him when I the first time I talked to him.
Feel free to use it. I can get you a great restaurant reservation
Okay.
once they reopen.
Awesome. Well, thanks so much, guys. Appreciate everyone jumping on here. Appreciate the audience chiming in with questions. It was great having you. A ton of value in this one, and we're gonna have the recording, so we'll be sure to share this with everyone that was participating as well. So thanks again. And as far as audience goes, we're gonna give it another 5-minute intermission here. Regroup at 5:25, and we march onwards.
Thanks for having us
You all
on.
take care.
Thank you.
Absolutely.
Take care,
Thank
guys.
you,
Omar,
Rashad.
James, good to
Take care.
see you
Thank
guys.
you.
Hey,
Rashad,
good to see you.
be well,
Hey,
guys.
good to see everyone. Have a good one. Bye. Stay safe. Thank you, Rashad. Thank you, Dylan.
Thank you, Omar.
Thanks, sir.
My pleasure. Thank you.